Good morning, everyone. Thank you all for joining us this morning, bright and early, so welcome. So happy all of you could join us. This is our first in-person Summa Business Breakfast since 2020. I think we had it in January 2020, so thank you all for joining us this morning. We truly appreciate you all being here. I'm Kathy Tricca. I'm the director of the Summa Society, which is our leadership giving program, and many of you are members, so thank you. We truly appreciate all that you do for Suffolk, and we appreciate you being here this morning. I'm a proud graduate as well of Suffolk University, and I can tell you I have many members of my family. So my spouse, my husband's a graduate, my son's a graduate. I have a sister and a brother, a niece, and I have a lot of relatives that attended Suffolk, whether it be the university or the law school. So very proud of being Suffolk University graduates. I joined Suffolk and so happy to be back 5 years ago. I can't believe it's 5 years. Got through the pandemic, but I spent over 30 years in financial services, and I'm really happy to be here and being able to meet a lot of friends, a lot of alumni, and a lot of people that I've reconnected with, and so happy to be here. I have the great pleasure of introducing President Kelly. We are so happy that she is the president of Suffolk University, and she's done so many great things over the past number of years, and we're really on a great trajectory with the university as well as with the law school. So welcome, President Kelly. Thank you.
Thank you, Kathy, and good morning, everyone. It is wonderful to be here with you today. I know I am looking forward to hearing all of Trustee Ken Taubes, our keynote speaker this morning, to hear everything he has to say. It's going to be a great morning and a lot of great information for all of us. I mentioned Ken is a trustee. We have some other trustees who are here with us this morning. So I think Nancy Stack is right here in front of me. Trustee Susan Regnetta, I saw you somewhere. There you go. I think that's all for current trustees. We have some former trustees who are here with us this morning. Dan Connolly and Jack Harrington, thank you so much for being here. Did I miss any other former trustees? Current trustees? Excellent. Well, again, thank you all for joining us. And as you heard, this is the first time we've had this event back in person since before the pandemic. And we've done it a couple times virtually since then, but really nice to be all together in one space. I remember that event in January. I think you're right, Kathy. I think it was January of 2020. And I had the chance to be up here and to speak with everybody who was there, some people who are here again today and others not. And I had the chance to talk to you about what was at that time the brand new strategic plan, Suffolk 2025. And I was talking with you about the most critical elements of that plan. And essentially, what I think I said was that Suffolk 2025 was fundamentally, at its core, a lot of different initiatives, but at its core, about the university harnessing the full power of experiential learning to ensure that our graduates were ready for professional success and to have a positive impact on their communities, both when they graduate and over the course of their lives, and that we would do that in a way that was consistent with and advanced our mission as an access and opportunity institution, and with our very strong commitment to diversity and inclusion and advancing inclusion across the institution. And in 2020, just about 8-9 months into that plan, we were off to a great start, implementing across the board, and then the pandemic hit just a few months after this event. And as you all know, that upended everything for everyone quite a bit. So in late spring 2020, we sorted through everything. We figured out how we were going to operate. We moved everything virtually. And once we had done that, and we knew we could continue to deliver on our commitment to our students and our alumni, then we said, okay, we got to take a look at this strategic plan, figure out what we should still be doing. Does it still make sense? The whole world has changed. And we did that. And, we had to shift some things here and there. Some initiatives were pushed back on the timeline. But for the most part, we said this still makes sense. And thanks to the support of the Board of Trustees, we made the decision as an institution to continue to invest in the key priorities of that plan and to move forward because we felt it was in the best interest of our students, our alumni, and the institution over the long term. And so now I am back here really happy to be able to say that we did that. And because of those investments, while we are still coming out of COVID and still dealing with some of the hangover effects, if you will, just as the world is, and certainly as higher ed as a sector is doing, while we're still dealing with that, I'm very happy to say that there's just an incredible amount of positive momentum at Suffolk. And much of that positive momentum ties back to the decisions that we made to continue to invest in those priorities that I was talking to all of you about back in January of 2020. And so I want to just highlight a few things that we're excited about, that we're proud of, and that I think speak to the forward momentum of Suffolk University. First of all, just touching on enrollment for a minute. At the undergraduate level, for the class of 2022, so students who came in this past fall, we had actually the first application growth in a decade. We brought in this past fall the largest class, the largest first-year undergraduate class since 2015. And that class of about 1,242 students, I think, if I'm remembering correctly, was 41% first-generation college students and 46% students of color. We are very proud of that. We are moving forward as an institution, continuing to focus on our access and opportunity mission and success for all. The law school. Again, enrollment has been off the charts. This past fall, we had a very large incoming class, and in fact, the year before as well. But very importantly, the academic profile, the credentials of that incoming class for the last 2 years have been the strongest they have been in a decade. And as we look to next fall, law school applications at Suffolk are up 4.99%. This is as of yesterday morning. They kind of change a little bit daily, but 4.99%, when applications in the United States are down by 3% and down in New England by 7.8%. All of those numbers speak to not only the excellence of our programs, the incredible hard work of our faculty and staff to deliver every day to our students, but also to the investments that we have made as part of Suffolk 2025 in continuing to be sure that people know about the good work that is happening here, continuing to advance our reputation and branding and marketing efforts in ways that help to really drive our success. So we're very, very happy with those results. Now, if you were here back in January of 2020, you may remember me talking about a central investment of the strategic plan being in our career services operation, primarily at the undergraduate level, because we had had a very successful career services operation, at least at the law school level, for many years. But at the undergraduate level, while there was good work happening in what was then known as the Career Center, it was a small unit and not fully integrated with our academic programs, particularly, again, at the undergraduate level. So we invested. We hired a new fabulous executive director, Dave Mary, who many of you may know, under the leadership of the Provost's office, Julie Sandell. And he and his team and all of us came together to reimagine, rebrand the Career Center, to integrate it fully in our academic programs in appropriate ways, and to vastly expand the staffing and the outreach that we could do to students. And so now we have the new Center for Career Equity Development and Success. It is sitting in a very prominent place on campus in the corner of Beacon and Tremont Street and the first floor of 73. Fabulous space where it's very visible to students, to members of the community, to employers. And they have just done incredible work. And after their first year of operation, we don't have the stats yet for year 2, but after their first year of operation, not only were the career outcomes for our students outstanding, 98% of graduates from the class of 21 employed or in graduate school, but the work going on in the center has really been amazing. And the degree to which students from the first moment they're on campus as first-year undergraduates has really, really been robust. So that first year, we had 3,481 unique student and alumni. The office also serves our alumni, unique student and alumni engagements. 73% of all of our Pell eligible students are taking advantage of the center. 64% of our international students are taking advantage of the center. And when you look across the racial identity, white, Black, Hispanic, Asian, American Indian, Alaskan Native, the numbers are parallel and growing all the time. Of course, we'd like 100% of our students to use it. But in the first year of operation, to have 59% of students who identify as Black using the center, 63% of our Hispanic students, 56% of our white students, 64% of our Asian students, and 64% of our American Indian and Alaskan Native students. Those are fabulous numbers for a brand new initiative. And again, only possible because as an institution, we made the decision to continue to invest in the core elements of that plan. And we're really seeing the success of that operation. And finally, I want to just talk a bit about advancement. I mean, this is a Summa Business Breakfast. We have members of our Summa Giving Society here with us and so appreciative of all they do. In terms of advancement, since 2018, we have achieved the 5 best fundraising years in the university's history. And in fiscal 22, we raised more than $10 million for only the second time in the university's history. And all of our school-based alumni boards have achieved a 100% giving record for the 5th year in a row. That is absolutely incredible. I can tell you, I talked to a lot of presidents, and I have not, college and university presidents, and I have not run into one other president who can say the same thing about the support they're getting from their alumni organizations. That is really incredible. Yes, Suffolk is on the move, and it is on the move because of the hard work of our faculty and staff, but it is equally on the move because of all of you, because of our alumni and friends who are so critical to our success. So would you all join me in giving yourselves and all of our other donors a round of applause for all you do for Suffolk every day? We are so very appreciative. And to underscore for all of you the impact that you have on our students, we are very fortunate to have with us today a student speaker. She is the recipient of the Ken and Wendy Taubes Endowed Scholarship, graduating from the Sawyer Business School in just a couple of months now. Would you please join me in welcoming to the podium Ana Luisa Alvarenga.
I'm a little shorter than President Kelly, but thank you, President Kelly, and I would like to say good morning. My name is Ana Luisa Alvarenga. I am a second semester senior, and I'm majoring in marketing. I'm excited to graduate this May, and I'm excited to share my Suffolk story with you this morning. Growing up, my parents have always prioritized anything and everything they could to benefit my education as well as my siblings. They worked tirelessly, spending late nights cleaning offices and sometimes missing my dance competitions so that they could work. Now that I'm about to graduate from college in May, I can see the immense opportunities that Suffolk has given me, and I can see that their hard work and support was all worth it. Suffolk has allowed me to see that this world is my oyster. While at Suffolk, I have been able to identify my passions and cultivate my integrity. During my junior year, I had the opportunity to study abroad in our Madrid campus. If you had told me in high school that I was going to be studying in a different country, I would have thought you were crazy. The people I got to meet, the culture I got to experience, and to be the first ever member of the Alvarenga family to be studying abroad was beyond belief. None of these opportunities would have been possible without my parents' sacrifices. Though, through all this time, my self-confidence has increased. After I graduate, I plan to build my career with my passion for fashion and brand marketing, a path I feel brave enough to explore because of my growth and development here at Suffolk. Being a first-generation college student has not been easy, but through the lows and stressful moments of being a student, my experiences have molded me to become the driven and passionate student I am today. I am here as a graduating senior thanks to the financial aid I have received from this university that has made my Suffolk education possible. Financial aid is an essential for first-generation students like me, and I am the proud recipient of the Ken and Wendy Taubes Scholarship. I would like to take this time to thank Mr. Taubes and his wife for establishing and funding this scholarship, which has helped my far-off dreams reachable and attainable, and will help many other students in the future. I'm truly grateful. It is my honor now to introduce Mr. Ken Taubes, a distinguished MBA graduate of the Sawyer Business School. As Executive Vice President and Chief Investment Officer at Amundi US, Mr. Taubes oversees the United States Fixed Income Team, Equity Team, and Multi-Asset Team, including portfolio management, fundamental research, and trading. Today, he will share his insights about the 2023 economic outlook. Please join me in welcoming Suffolk University Trustee Ken Taubes.
Well, now that I'm suitably embarrassed, and let's see if I could pull myself together on this one. That was very good. Thank you very much. And I'm reminded, by the way, when I went to school, it's been a long time now, in the 80s, and I remember it was around $4,000 a year all in. And I thought that was a lot at the time, but, and no, of course there's been inflation, but what people miss often is that the rate of inflation for education over the last 30, 40 years has been far in excess of the general inflation rate. So it is truly the fact that the cost of education today is much more expensive than it was when most of us went to school in the 80s and 90s, frankly. So that's why I think it's awfully important for us to help support these students, because it is much more expensive today to go to school, unfortunately. So great, thanks for those comments. I have about 20, 25 minutes of time, I believe, to go over a lot of information, and we have far more charts I'll show you than I'm actually going to go over, but they'll be available for you. We can send them to you. They've been all compliance approved. We are in a SEC regulated industry, so we have them approved for general public use, so you'll be able to get them if you're interested in looking at them in more detail. But I want to go over today a few things. First off, a little bit about where we are, where the economy's heading, and most importantly of all, what are the implications for investing? Because at the end of the day, often the economy goes in a different direction than the markets. It's not the same thing always, but it is a very important factor of how you invest and how you think about where you may want to invest. And I must say, this is a pretty tricky period. I don't think it's ever easy to invest. If you probably know, if you've done any research about investing, most active managers don't beat passive benchmarks. So if it was so easy, you wouldn't have those statistics. Although it's not quite as true in fixed income, but certainly in the equity markets it is. So it's an even more tricky period. And of course, why is that? A few reasons. One, we've had a very, very severe inflation environment over the last few years, and many people will debate how we got there and why it came about. Of course, I have my own views, and we can talk a little bit about that. And the direction of inflation, of course, is really important to investment values, and we'll talk about where that's heading. And then I'll try to go over a little bit where we are economically. Of course, we just had a little bit of a shock to the system over the last 2 weeks with a number of banks going under, frankly, including SVB, I think the 16th largest bank in the US. And by the way, a pretty strong Boston connection because they acquired Boston Private Bank a number of years ago. And a little known, I think, is they had a very large deposit base of not-for-profits in the Boston area. So I know there were quite a few not-for-profits and other companies quite concerned about making payroll a few weeks ago. Obviously, it's worked out okay for them. And we still have a central bank that's very active in the markets, and by the way, globally, frankly, and also geopolitical risks are rising as well. And then, of course, we have to examine the valuations in the market. So let's see if we can pull it all together. And I must say that I think that we're getting a lot of mixed signals. If you look at the economy today, the quarter that's going to end in a few days, March 31st, looks really pretty strong, actually. People have been talking about a recession for 6 months or longer, but GDP in the first quarter looks like nearly 3% based on the data we've seen so far. Probably too hot for the Fed, frankly. And that will likely be, in my view, the peak of the year in terms of quarterly GDP data. And I think the market has been very happy about all that as it sees the data come in, because the market had been priced at the end of the year before October and into the fourth quarter for a recession, and we're not having one right away. And I still think we're going to get one, frankly, but I think it's following a very normal course of action. And what I want to go over first off is where we are. This year, we started off with much better investment results so far. The equity market's up, the bond market's up, after a very tough set of numbers last year. Amazingly, I looked at the equity market from the day before the news on SVP to today, and the market's up. Probably not a result you would have expected. In fact, the NASDAQ's up 4 or 5%, and even the Dow's up a little bit. So the market's taken the banking crisis to date so far so well. I think that if you look at these investment results, even this year, even offshore results are a little bit better than they have been in the last few years. So pretty good so far. In fact, the NASDAQ is up about 14% year to date. That's pretty bubbly, actually, given how much the Fed's been tightening rates. So we have a situation which I'll talk about what the valuations look like. My own view is that as we move along here, let's see if I can get this thing to move. Oh, it does move, just okay. I think we have to talk about the Fed. I think that's the elephant in the room. And I think when I look at the Fed today, and this is true of other central banks, because in the last few weeks, you may have noticed, the ECB raised 50 basis points in the middle of the banking crisis. The Norwegians raised rates. The Swiss raised rates in the middle. Right after they took over Credit Suisse, they raised rates. So we're seeing, still seeing a lot of rate hikes in the global economy, frankly, with the one exception in China, perhaps. But I think people look at the rate hikes. They see the rate hikes. They're in the paper all the time. They watch interest rates. But one thing people don't really watch that much is the other aspect of the Fed's tightening. Because the Fed affects two things: the price of money and the availability of money. The price is the interest rates, and that gets good headlines. But they're also doing, in the background, every single day, quantitative tightening. They are selling their balance sheet down. They're selling treasuries. They're selling mortgages, shrinking their balance sheet. So the raw material that the banks have to lend is going down. In other words, excess reserves in the banking system are declining. So the banks have to work harder to lend because they have fewer and fewer reserves. Liquidity gets tight in this environment, and you see it. You've seen SVB, for example. So the quantitative tightening works behind the scenes, day in and day out, up to $95 billion a month. And not to get too wonky about it, but the monetary base, which is basically reserves at the bank, at the Fed by banks, and also in currency in circulation, is down 16% year to date. That's a lot of shrinkage. If you look at the broad money, the so-called M's, year over year, they're now negative. This is not a good situation. That's why liquidity is tightening in the banking system. And if you're a bank, Forget about going out of business. I'm not even going to talk about banks going out of business. I think SVP was an anomaly because we run the 50, 60 banks that are investable in the US in public security markets, and they were the only bank on our list that showed after mark-to-markets on their available for sale and their mark-to-market on even their held to maturity of negative tangible equity. Very unusual. So once the liquidity started getting squeezed, they could not sell securities without killing their capital, and that's what happened. But most banks don't have that situation, most of the big public banks. But liquidity is getting squeezed. So even if you're a well-capitalized bank with good liquidity, at minimum, what's happening is you own assets. Now your deposit costs are going up because the Fed keeps raising rates. So look at Bank of America. Many of you probably look at, I don't want to pick on Bank of America because they're just like all the other banks, but your money market account's still 5-10 basis points. 5-10 basis points. The T-bill rate was 5% 3 weeks ago. You can still buy T-bills at nearly 4.5, 4 3/4. You probably have noticed your government money market's 4.5, 4.75, government money market. So you have to be asleep at the wheel to not move your money from your money market account to from your bank account money market to a government money market account or buy a T-bill. So the banks are getting squeezed no matter what, even if they're unhealthy. So their net interest margins are going down. And they're raising rates. You probably looked in the Boston Globe, a lot of advertising these days for CDs. The big banks have tons of excess capital, excess liquidity, but the little banks don't. The excess reserves in the banking system are not evenly held across the banking system. So the banks, if you're worried about your net interest margin, your profitability going down, people taking deposits out, not because they're worried about your bank, but because they can get a better yield over here, you have much less money to lend. So this is going to continue to cause lending conditions to tighten. If you look at the quarterly commercial lending surveys, they're tightening. It comes out once a quarter. The last one was much tighter than the last few. Furthermore, what happened at SVP, what's going on in the background, I'm sure when we see year-end's quarterly survey in the next few weeks, it's going to be tighter still. When lending standards are tightening, it's not easier to get a loan. What do the banks do to make it through this? They raise the price of their loans or they make fewer loans. So this is, I think, happening. And this is going to continue to drive the economy much slower, in my view. So we're going to see this. And the Fed is still raising rates. They raised rates after SVP. You know, it was a 50-50 toss-up whether they should have done that. But they're very focused on inflation. And I have a lot of inflation data here. I'll show you in a second. But you could see already, not just the availability, but on the price. Here I graphed real yields. These are TIPS, so Treasury Inflation Protection Securities. And the real yield is the beige. It's 133. Before and during, right around the pandemic and immediately out, I mean, we had negative real yields. If you bought a TIP in April of 2020, early 21, you actually got a negative real yield, which was a little bit of a problem. But it's exceptionally easy monetary policy. But now real yields are rising. So we have the availability of liquidity going down and the price of money going up. That's not good for the economy. It takes a long time to work its way through, but it's going to happen. And people look at this. It manifests itself in the yield curve. If you look at the yield curve today, you have short rates at 4 3/4, 5. That's the Fed. I think Fed funds 482 yesterday. And you have 10-year notes at this morning, 356, 357. I mean, this is 120 or so basis points of negative slope, inverted yield curve. That's not a great environment. And that's a reflection of a tight monetary policy. And if you look at the historical data, 12 to 14 months after the first inversion of a sustained yield curve inversion, you have a recession, the beginning of a recession. I wasn't expecting a recession at the end of last year or the beginning of this year. That's too soon. 12 to 14 months from when the inversion took place is probably the middle of this year, this summer, the fall. Maybe it could go as late as it would be in the window of averages, the range of averages, even if it went into the first quarter of next year. So what I would say is with a lag, because people often say the Fed works with, what they do has a long lag. 12 to 14 months on average, but as short as 8 or 9 months and as long as almost 2 years. So the window of when I would expect a slowdown, a really severe slowdown, if not a recession, is going to be starting this summer into Christmas or early next year. So I think that's where we're headed, frankly. And I don't think the SVB thing makes it any easier. Even with the Fed and what they were doing, I mean, no banker wants to be the next SVB or Signature Bank, or even the next First Republic, frankly. And so they're going to maintain more liquidity than they might have otherwise. They're going to be very careful. So I think all of this is, as a consequence, is going to tighten credit conditions even further. So I don't want to be so negative, but as some of you who may hear me talk in the past, I like to call them the way I see them, not the way we hope. And otherwise you don't have good investment performance. So this is a little bit of a problem we have. And what's the likelihood of really the Fed stopping? Because I think that's the next question. And without, you can't really figure that out unless you look at what's happening on inflation. So I have a few charts on inflation. And I must say on inflation, frankly, what I see is it is heading in the right direction. It's clear it's peaked. Inflation has peaked in this cycle. And how do I know that? Why do I say that? Because the conditions that created all the inflation is behind us. The conditions were principally a monetary policy that was way too easy for too long and turbocharged with fiscal policy. No matter what they say in Washington, the fiscal policy turbocharged inflation because you had a constrained economy on the reopening against fiscal stimulus that was cumulatively over 20% of GDP. Where can all that buying power go? There wasn't enough product globally. So inflation was everywhere. And the Fed was slow to recognize it, and here we are. But the conditions that created that are no longer. There's a little bit of tailwind still from fiscal stimulus. People were worried about it after the pandemic that they'd cut back, but they haven't cut back that much. In fact, GDP last quarter, or more than a quarter of it, was government spending. And we have some bills that are still working their way through. They were passed, but the money's still working their way through. Furthermore, the states were flush. A lot of it was because, frankly, they were flush from money from Washington. And with a year delay, they started spending it now in last year. They didn't spend it right away. In fact, most of the legislatures, including ours, argued about how to spend the money for a long time. And a lot of states were sending out checks, just like Washington did. But, for example, California did it not many months ago, late last year. Now, our legislature didn't want to do that, but they were forced to. In Massachusetts, many of you, if you paid taxes last year, you got a check. And that's also stimulus, right? So there's still a little bit of that, but going forward, we're going to have a battle on the budget, and we're not going to have the fiscal stimulus that we had. And we already know the Fed is already tightening a lot, a real lot. So I think inflation is going to, with a lag, because inflation is not a leading indicator, it's a lagging indicator. It's going to come down. And what we're seeing in the inflation data so far is, frankly, goods inflation is deflating, first and foremost. And that's because, frankly, I think a lot of the demand has been satiated. A lot of, frankly, excess demand was in the housing sector and appliances and all that, particularly constrained because of the lockdowns. So against rising demand, limited supply, a lot of those prices went up. Now we have a slower housing market, which is the first to go when the Fed starts raising rates, by the way, and much better supply chains. So goods inflation is begun to come down. More sticky is services. And I have a chart here, maybe I can find it. The really sticky part of the market is services. Services are, by the way, definitionally rental prices, their airfares, their other travel expenses, hotels, medical services, things like that. They're much stickier. They're much more related to labor, if you think about it. And labor is in short supply. In fact, there's still almost 10 plus million job openings against unemployed of 4 or 5 million. So we have almost, not quite, 2-to-1 job openings in the US. Now I think it's shrinking, but still a labor imbalance, particularly in, frankly, entry-level positions. If you're in the hospitality area, services. One of the big job growth areas still, by the way, is education. I don't want to say university education or colleges, but in public education, because there's still a shortage post the pandemic. So there's a lot of demand. I think there's a very systematic shortage of healthcare workers in a lot of the health services industries. I mean, you probably know how hard it is to get an appointment over one of these medical facilities. They still don't have enough nurses, doctors, everybody. So there's still a lot of job hiring there, but you've begun to see, frankly, job contraction in some industries. Probably one of the areas where there's been the most hiring over the last few years has been in IT. IT is getting tight. We've even last month in the payroll data, big payroll number, negative job growth in IT, information technology, because you see in the headlines, you know, the big West Coast tech companies keep laying off people, among others. So we're beginning to see some early hints that maybe services inflation will come down, but it's still running 5%, almost 6%. There's been almost no progress on services inflation. That's why the Fed's annoyed still, probably. And the overall rate is coming down, but with services being sticky. Now, the one thing they have said, and we tend to agree with, is that one of the biggest components of services inflation remains the way they calculate housing data. They don't actually directly put house prices in the CPI. They stopped doing that 30, 40 years ago. And they only use owner equivalent rents. They call up homeowners and ask them, how could you rent your house at what price? And that's how they work. And it works with a huge lag, 6, 8, 9 months. So that's why Chairman Powell goes out and says, you know, I'm pretty confident we're heading in the right direction because the housing data is, you know, calculated with a long lag, and I expect this to improve. But the court, now they got to cut so finely, core services, ex housing is still very sticky. But I think a lot of that has to do with employment, and it's a very lagging indicator. And if they myopically focus on that, they will over-tighten, because that component of CPI does not lead, it lags. And the Fed has to, you know, have the courage to ignore that at a high level and have the courage of their conviction when they look at what's happening in frankly, lending circles, and they're tightening. So I think there is a risk that they over-tighten again. They would probably have to stop right now, stop tightening in order to have a soft landing. Otherwise, they're just not going to have a soft landing, in my view. And I think the way the economy works, I just think this is an important chart. This is a framework, the way I think about it. You have the Fed's raising rates, inverting the yield curve. What gets hurt first? I already said the housing market. Housing prices year over year are flat to down. And if you look at mortgage applications, refinancings, way, way down, okay? So clearly the housing market's slow. Typically, 2 years from the peak in the housing market to the continued tightening, you have a recession. So the housing market is well advanced in its slowdown. Now, with a footnote, the housing market is not 06 and 07. It just isn't. There's no excess housing in general. And I have another chart, maybe we'll show it to you, but I'll tell you, there's a far greater persistence of demand than there was in 06 and 07. Because of, not to be pejorative, but the so-called millennial generation, which is now mid-20s to mid-40s. That is historically prime family formation years, prime childbearing years. That's when people buy their houses, and that's when they spend money. And frankly, people also don't always realize this, I'm sure demographers do, but the millennial generation is the biggest cohort in the United States. Bigger than the baby boom generation. And they're going to have an impact on housing. They are having an impact on housing. So whenever you see housing prices come down a little bit or rates come down, there's automatically a persistence of demand. This is not like 06 and 07 where there were just too many houses with too few people buying. So I think housing is in a normal cyclical downturn related to rates. But with the lag, after housing, then you have the manufacturing sector. It's starting to weaken. If you look at some of the leading indicators, not the lagging indicators, like surveys from Institute of Supply Managers, it's so-called ISM data, new orders have begun to collapse. That's a leading indicator, not a Now, in production and manufacturing. I think on the services side, because of the pandemic, it's still relatively robust. But the ISM new orders components of these indices are at near recession levels already. And with a lag of almost a year, you start to see a recession. And then what happens? Companies are starting to be squeezed. Housing's weakening. It's a big multiplier effect in the economy. Manufacturing's weakening. Also a big multiplier effect in the economy. So earnings begin to fall. Margins begin to fall. And that's what's happening slowly. We've already knocked 2 points off corporate margins. And eventually, with a lag, not first and foremost, but with a lag, employment weakens. And I unfortunately think the job market's going to get worse, not better, because we're on this path. And sometime, I suspect this summer or fall, or we're going to have even, barely positive growth or even a recession. And we're already 0.2 of a point off the lows in the cycle in the unemployment rate. And historically, when it's been up 0.5% over a year, you have a recession. So we'll be monitoring that closely. But employment is a lagging indicator. And it's also problematic because the Fed has a Phillips curve model they still use. And they tie together in the Phillips curve model employment and inflation. And I guess I have a little different view on that. If you have high real rates and high productivity, doesn't mean necessarily that strong wages and strong employment causes inflation. I think it depends on the circumstances. And unfortunately, we've had low productivity and, frankly, high inflation and low negative real yields. So I'm not convinced that the wages are not inflationary. And just as a political side, I have a chart in here in the package, and I'm not going to get to it all, but showing you that on the one hand, you hear Washington say what a great economy we have, but when we look at the surveys, people are upset and very low feelings about the economy. And I think it's related to the fact that even though the unemployment rate is very low, inflation's even higher than their wage growth still. So even though wages are up 4 or 5%, inflation's up 7 or 8 over the last 12 months. So people are working like dogs. They got their job, but they're not staying even. They're still falling behind. So people don't like the situation. This is why inflation's such a political mess in Washington. So I think we're on this path, and we're going to unfortunately see a weaker economy. I think it's already baked into the cake because the curve has been so inverted for so long, and now it's going to be exacerbated with this mini banking thing. So that's the story there. Right now, if you look across the bond market, yields are near their highs over the last decade. Not quite there. We've had a big rally over the last few weeks. But I must say, when I look at bond yields today, my inclination is to be still very high quality because we still have in front of us a recession or at minimum a very weak economy. And this is not the moment in which to buy, I think, down in credit, high yield, or other risky credit assets. And furthermore, when I combine that fundamental outlook with how they're priced, which I'll show you in a second, they're not greatly valued. In fact, the spreads on credit today are not very high relative to what the economic outlook looks like. In fact, in other words, credit spreads nor the equity market discount a recession at the moment. They're fairly average credit spreads. We're not looking at average. We're probably looking at below average growth in the coming year. So that's one issue. But I do like to think that government bonds, short to intermediate government bonds, look like a pretty good value because I do think inflation is going to come down and the curve is very inverted. So I think you are getting paid to hold treasury yields or high quality corporates or even high quality government mortgages in the front end of the so-called yield curve, in the 3 to 5 year part of the curve. There's a lot of people flocking to T-bills. And of course, you can maximize your income by buying T-bills or your government money market fund, but those yields are not likely to be there in 12 to 18 months if we go into recession because the Fed is going to be forced to cut rates. In fact, the market is anticipating the Fed's going to cut rates. If you look at the forward Fed funds market, there's a futures market and curve out there. The market's expecting the Fed to raise rates one more time in May, 50-50, not clear, but that's the peak. And then beginning sometime this summer, the market's expecting the Fed to start cutting rates. So the bond market is already beginning to think, at least the government bond market is beginning to think the Fed's going to be forced to cut rates sometime this summer, which is not disaligned with the way I think about it. So if you're piling into treasury bills, it's a short-term solution. And maybe that's fine, because maybe you want to buy a house, or maybe you want to take a trip or refurbish a house and you need the money no matter what. But if you're thinking about savings a little longer, or maybe a short-term intermediate bond ladder in that 3 to 5 year, 3 to 10 makes more sense, because at least those yields, when the treasury market rallies, I guess, when the Fed starts disinverting the yield curve, you'll have those yields for a few years at least. And that would be my observation there. And I do have this chart here, which is maybe hard to read, but basically looks at the 4 big components of the public bond markets: mortgages, investment-grade corporates, high yield, and bank loans. And frankly, you could see everything looks pretty average. But if things go into a recession, it's not prepared. That's the issue, okay? That's why I'm not recommending that right now. Then we look at the stock market, where most people have more of their interest in the bond market, like myself. Now, in the equity market, you might say, geez, we had a banking crisis, economy's going into a recession. Why is the stock market up? It's a little anomalistic, right? Well, I can't fully explain it either. No one really knows. But I suspect a few things. One, because of what we've seen since the end of the year, rates have come down. The market's starting to think the rates are coming down. And when you look at what parts of the equity market have performed, it's the markets that's most sensitive to interest rates. Long duration equities with no earnings or no dividends, growth into the future. So as interest rates come down, the 10-year notes come down 50, 60 basis points at least, those kinds of stocks, when your present value, that outlooking cash flow, it looks more valuable than it did last year. And that's the part of the market that got hit last year a lot when interest rates rose a lot. So I think that's one thing. I also think the market's looking at the GDP, the 3% GDP we're going to have this quarter, and it's not seeing the recession yet. So there's always going to be skeptics. I mean, I read in the paper all the time. We have this debate internally, by the way. Where's the recession? 3% GDP. Fourth quarter wasn't too bad either. And, you know, the forecasts of lower profits and earnings per share are not in the windshield right now. No one's seeing it. It's too far off. That's another issue. So I think that it's largely an interest rate story. I also think there's a lot of rotation, you know, not abandoning ship, changing the decks, because the big cap, you know, big growth, cash flow, fortress balance sheets that you're seeing, those are the ones that are doing well. Weak companies, you look at the Russell 2000, it's very weak this year, frankly, relative to the big caps. So I think underneath, you're seeing a flight to quality, a flight to big cap, a flight to, you know, because rates have come down and because no one's seen the recession yet. But if you look at the valuations, this is where we have a problem. And if that forecast comes true, the stock market's probably okay. And the issue is inflation. You have to have because there's two things here going on for stocks, right? It's the valuation and the earnings. And when you look at the PEs today, the S&P is over 18 times earnings, 8.182, 18.3. And if you just look at inflation, I said it's still 5-6%. You know, if it persists here and it doesn't come down, we got a problem with the PEs. Because if you look at that chart and you channelize, you know, the various bucket inflation, the PE is too high for the current inflation rate. So the market already thinks inflation's coming down a lot. In fact, it has to be 2-3%. Otherwise, frankly, the PEs are not well justified at these levels. In fact, if we stick at this level, PEs ought to be 14, 15 times at best. So that's an issue, even if earnings don't come down. So the market is already inferring a decline in inflation, which I don't disagree with, but it's already priced for it. So there's no upside to that, in my view. It has to come to fruition for the prices to stay where they are. That's one thing. And the second thing, which this chart doesn't show you, is that earnings for next year are $225 for the S&P. And our forecast, I already said, there's a chain of events, and we're already seeing margins getting squeezed. We think profits are going to be more like $200. So when you look at the PEs, you look at the earnings per share, the market is really priced for perfection at the moment, and that's the issue. Longer term, there's some great, you're starting to see opening up on some values. I mean, I don't think maybe in the short term, but over the next 3 to 5, 10 years, small caps are finally starting to be very well priced. The large cap part of the market that you get in passive large cap is still very, very expensive and priced for, pretty much perfection on earnings and frankly, inflation. So I wish I could deliver a great story on this, but I think for now, we still have to hide. There's some good bond opportunities in high quality bonds. We haven't seen those for decades, really. And with declining inflation, I think that that's an opportunity in near term. We'll have to see what the equity market does. If my recession story doesn't hold up and we can avoid it and skirt it and inflation comes down to 2 or 3%, the equity market will be okay. But I'm just saying it's very asymmetric, the risk right now. So I'll give you a few minutes if there's any questions. I know we're probably running a little bit behind. Oh. Okay.
For a couple of minutes after, for those of you that have questions, and ask questions, we want to stay on time. I know numbers you need to get back to work, but if I could have Pamela come up. But thank you, Ken.
Perfect.
Good morning, everyone. Thank you, Ken. It was a little grim, but I appreciate your candor. So my name is Tamala Bailey, and I am a graduate of the law school 2004. I was just telling folks at my table that I can't believe it's been so long. Doesn't feel like it, but it has been. I am the president of the Law Alumni Association Board. I am also the chair of the Suffolk University Black Alumni Network, which we call SUBAN, if you've ever heard that term. And I'm a proud member of the Suffolk Summa Society. So again, I want to thank Trustee Ken Taubes for sharing your insight on what is obviously a very timely topic we need to be paying attention. A big thank you to Kathy Tricca and Tara Balan. I hope I'm saying your name correctly. Of course, we always want to thank the Office of Advancement for doing such a great job putting on these events and this wonderful breakfast. Oh, hi, Jenny. I didn't see you earlier. So I'm going to share with everyone why I am a Summa donor and why I think it's important. And I'm sure you will all agree with me. So I give back at the Summa level for many reasons. I'm going to talk about the 3 most salient. Otherwise, I would be up here all day, right? So the number one reason that I give back is because of college reputation. And I say this when I'm encouraging my SUBAN Leadership Committee and the folks on the board to, do fundraising. And when you're talking to folks, you want your degree to mean something when you're out in the world. When I say I went to Suffolk, I want it to mean something to the person with whom I'm speaking. I want the eyebrows to go up like, hey, oh, you went to Suffolk? Oh, that's a great school, which I do get, and that's why it's important for us to continue to invest in our alma mater. I do a lot of volunteer work. Haven't applied for a job for quite some time, which is probably a good thing, but when you apply for a job, when you're going out for opportunities, you want your Suffolk degree in the school that you went to mean something, and that's a reason to give back because you're investing in the university. I know that I know my contributions go to improving the school. I know that they're building new facilities and they're adding to the technologies that students will access, so that they can have a good education. And I think also for many, the percentage of alumni that donate to a school tells them something about the university or college. I think that means something. So it's another reason for alumni to donate. Also, I see a lot of students in the room. You're moving on. You've been educated at this great institution, and please give back. So the second reason is giving back shows gratitude, right, for everything that I just mentioned. I personally enjoyed my time at Suffolk. We had a student speak earlier about her experience here at Suffolk, and Suffolk has poured so much into us. And quite honestly, the places where you've been educated, kind of provide the pathway for your life. And in my view, how can you not look back and give back and reach back and pull up? So I think it's important for me, and that's why I do it as well. I've developed so many great lifelong friendships, great memories, many, many experiences and lessons learned. And of course, the professors have poured into us and have influenced us both professionally and personally. So that's the second reason. And then the third, of course, I do a lot of volunteer work here at Suffolk. I was a student once, obviously. And I think students, they're the focus, and the future generations are going to benefit from our contributions. As many of you know, it's not very easy for the students to find funding for college. And while we're out in the world, a lot of us very successful and doing great things, there are students here who are trying to make a way for themselves and, give back what you can to the extent you can do 1,000 or more. Please do so. So that's it. Those are my 3 big points for why I give back. I do want to thank everyone for giving back to Suffolk, who do give back now, for all your financial support. If you give your time and energy, of course, and your talent, we're grateful for that. I do ask those who are not giving at the Summa level to please join us and give a gift of $1,000 or more. For all the reasons that I stated, your money will be put to good use, and you can join the hundreds of Suffolk alumni like myself and other friends who are philanthropic leaders at the university. So this closes this morning's program. There's still food over there, and I hope that everyone has a splendid day. Thank you.